So, you've probably heard the buzz, right? About Warren Buffett.
Oh, yeah. Holding this absolutely massive pile of cash.
Exactly. And, well, lots of people are talking, interpreting it as maybe a big warning sign for the stock market.
Like he sees something coming, a crash.
Right. Is he seeing something we're not? Are we, like, teetering on the edge of a major downturn? That's really what we want to dig into today.
Yeah, our focus for this deep dive is trying to understand the real reasons behind Berkshire Hathaway's much bigger cash position lately.
We'll be looking at, the 2024 annual report?
That's right. And some key comments from the shareholder meeting this year, 2024. Plus, we're bringing in some perspective from that YouTube channel, Rule #1 Investing.
Okay. So the goal here is pretty straightforward, really. We want to try to cut through the noise, the speculation, and figure out if this huge cash pile is Buffett signaling a crash.
Or if there's maybe, another explanation, something more nuanced going on.
Yeah, we want to give you some clarity, hopefully, without just adding to the financial information overload.
Okay, so first off, there's this popular idea, especially in, value investing circles. They call it the Buffett indicator.
Right. And the thinking goes.
Well, the thinking is that when Buffett's cash levels get this high, historically high, it means he's basically bracing for a big market drop.
Like a serious correction.
Yeah, maybe something in the range of, say, 30, even 40%. That's the narrative.
It's definitely a compelling story, isn't it? You have this legendary investor famous for picking stocks.
Absolutely. I
Right.
mean, his whole reputation is built on finding great companies at good prices.
And then suddenly it looks like he's pivoting, just holding on to billions in cash. But the key question is that interpretation actually accurate?
Or is it just, the financial media kind of running with a good story? Hype.
We should probably remember his track record, though, the stock picking side.
For sure. There was that UNLV study, wasn't there? It showed that over a long time, if you just mirrored his buys and sells,
You could have done pretty well.
very well, something like 20% compounded annual returns. That's the Buffett, most people think of.
But then here's the twist, the really interesting part now. We're seeing this massive buildup of cash.
Which, yeah, on the surface seems like the total opposite of his usual game plan, right?
Yeah.
Buying undervalued businesses.
So let's look at the actual numbers. What are we talking about here?
Okay, so Berkshire Hathaway's 2024 annual report, end of the year, they had $48 billion in cash.
Just cash.
Right. And then on top of that, they were holding a huge amount, $286 billion in U.S. Treasury bills. Short-term stuff, basically cash equivalents.
Okay, so add those up. But that was end of 2024. What about now or more recently?
Well, if you factor in estimates for cash, they likely accumulated in the first, say, 4 months of 2025. Some analysts put the total current cash figure around $360 billion.
Wow, $360 billion in a portfolio that's worth what? Roughly $600 billion?
That's like 60% of the portfolio sitting in cash or equivalents. That's a record high for them.
And how does that compare to, say, a couple years ago, just for context?
Good point. 2 years prior, their cash was about $167 billion. The portfolio size was similar, around $590 billion.
So that was maybe, 28% cash back then?
Yeah, around 28%. So you can see it's basically doubled the cash percentage pretty recently.
Okay, so understandably, that kind of move makes investors nervous.
You bet. When a guy like Buffett, with his history, starts piling up cash and selling off chunks of his portfolio.
You start wondering, does he see something bad coming, like a black swan event or just a really nasty market downturn?
And it's not just people guessing. I mean, Buffett himself has actually talked about this. He's mentioned concerns about the global economic picture.
Has? Where?
At the 2024 shareholder meeting.
Yeah.
He basically said these concerns are why he's comfortable, maybe even happy, building up cash right now.
Okay, so what kind of concerns did he actually mention? Let's unpack those a bit.
He listed quite a few things. Talked about global trade rules being reset, which creates uncertainty.
Yeah.
The massive amount of money printing that's happened globally, obviously leading to worries about inflation.
Which we're still feeling.
Definitely. Companies moving operations out of China, the whole China-Taiwan tension, that's a big one.
Yeah, geopolitical risks.
Exactly.
Mhm.
Plus the conflicts in Gaza, the war in Ukraine, the rising cost of living that affects everyone, high mortgage rates making things difficult.
And he even mentioned things like Bitcoin and gold prices being high as sort of fear gauges.
Yeah, reflecting a high level of anxiety in the system. So he laid out all these economic issues.
And so they make them more than happy to build cash.
Precisely. And well, some people hear that and think, okay, he's hinting at a major downturn.
Right. But Is there another way to look at it? You mentioned that rule #1 investing take.
Yeah, exactly. Their perspective, which they talked about in that YouTube video, it offers a really interesting alternative.
All right.
They suggest that maybe this huge cash position isn't actually about Buffett trying to perfectly time some big market crash.
So what is it about then, according to them?
Well, it goes back to the core rule #1 strategy, which is very Buffett-like anyway. Buy great businesses when the market's fearful, sell them when the market gets greedy.
Okay, buy low, sell high, basically, but applied to good companies.
Right. And from that viewpoint, this cash buildup now isn't some prediction of doom. It's just the natural result of the market being, well, too expensive right now.
Ah, so because the market's generally high or greedy.
The strategy dictates selling.
Yeah.
It triggers selling. And they pointed to examples like Buffett trimming his Apple stake or selling some Bank of America.
Because those businesses, while maybe still good, had gotten massively overpriced in his view.
That's the argument, that he was just following his discipline, selling what became too expensive according to his valuation metrics.
So the key takeaway from that perspective is it's not market timing. It's not prediction.
No, it's just applying a consistent investment strategy to the current market reality.
Yeah.
The huge cash pile is a result, not necessarily a forecast of a crash.
Okay, that makes sense. And do they offer actual evidence that the market is expensive right now?
They do. They point to several metrics, like the overall market price-to-earnings ratio, the PE ratio, is running around 27 times earnings currently.
And how does that compare historically?
Well, the average PE over like the last 140 years is closer to 14 or 15. So 27 is nearly double the long-term average.
Okay, that sounds expensive. What else?
There's the Wilshire GDP ratio. It basically compares the total value of the stock market to the size of the U.S. economy, the GDP.
And that's high too.
Yeah, it's sitting around 177%. Historically, 100% is seen as more normal. Maybe up to 120% is getting pricey. So 177% is way up there.
Wow. Any other indicators?
They also mentioned the Shiller PE. That's a cyclically adjusted PE, smooths out earnings over 10 years. It tries to give a better long-term valuation picture.
Yeah.
Also running at about double its 140-year average. These kinds of levels across these different metrics are comparable to what we saw around big market peaks like 1929 and 1999.
Okay, so the data suggests expensiveness. But isn't there a catch? Hasn't the market looked expensive by some of these measures for quite a while now?
That's a really important point they also raised. Yes. By some metrics, things have looked stretched since maybe 2017 or so.
Which really drives home how hard it is, maybe impossible, to accurately time the market, right? Just because it looks expensive doesn't mean it crashes tomorrow.
Absolutely. And you also have the factor of, potential government intervention, fiscal policy, monetary policy, things that can sometimes prop up markets or distort signals, making timing even harder.
So valuation metrics might scream expensive, but predicting the when and how of a correction, very, very tricky.
Definitely.
Okay, so if the market's expensive, leading to selling, what about the other side of Buffett's strategy? Buying things. Is he finding anything attractive?
Well, that seems to be the other major piece of the puzzle. He's apparently just not finding many great companies to buy at prices that offer what he calls a margin of safety.
That's his famous principle, right? Buying with a buffer, a discount to what the company's really worth.
Exactly. You need that discount to protect yourself if things don't go perfectly.
Yeah.
And it seems those opportunities are scarce right now, at least for him.
Has he said that?
Oh, yeah. Even back in his 2019 shareholder letter, it was 6 years ago now, he wrote that prices were sky high for businesses with decent long-term prospects.
6 years ago.
Yeah. And more recently, at the 2024 shareholder meeting, he used his classic baseball analogy. Said they only swing at pitches we like, and right now things just aren't looking that attractive on the buying side.
It really makes you pause and think about your own portfolio, doesn't it? Maybe apply that what would Buffett do or WWBD framework to your own holdings.
It's a good exercise. And there's another really critical factor, a constraint that Buffett has that most of us don't.
Yeah.
The sheer massive size of Berkshire Hathaway.
Right, because they're so huge, you can't just buy small amounts of lots of companies.
Exactly. To actually move the needle for Berkshire's overall results, he has to invest enormous sums of money. And that means he can only really consider investing in a very small number of the world's absolute largest companies.
And there's that regulatory aspect too, isn't there, about ownership limits?
Right. He generally tries to keep Berkshire's stake in any one company below 10% to avoid extra regulatory hurdles. So think about it. if he wants to put, say, $10 billion to work in one company.
And stay under 10% ownership.
That target company needs a market capitalization of at least $100 billion.
Wow. How many companies like that are there, roughly?
In the U.S., maybe only around 100 publicly traded companies meet that $100 billion market cap threshold. It drastically shrinks his potential hunting ground.
So he needs a very specific scenario. He needs prices to come down significantly, probably due to some big market event.
Right. And that event needs to hit these specific ultra-large companies that are also within his circle of competence, the industries he understands well.
It's a very narrow target he's aiming for.
Extremely narrow. He even mentioned this in his last annual letter, talked about how few companies out there are truly capable of moving the needle for Berkshire, and how there aren't many compelling options outside the U.S. either. It really paints a picture of a very restricted playing field for him.
Okay. So when you put all of that together, the expensive market triggering selling, according to his discipline, the lack of attractive buying opportunities at his required scale and price.
It seems much more likely that Buffett isn't necessarily sitting there predicting an imminent crash.
It sounds more like his actions are just consistent with his lifelong philosophy.
Exactly. Being fearful when others are greedy, which means selling assets he thinks are overpriced, building a watch list of great companies he'd love to own at the right price.
And making sure he has tons of cash ready, that wash tub, for when those opportunities do eventually show up.
Yeah, he talks about how dark clouds will fill the economic skies eventually, and when they do, they briefly rain gold.
And you need the wash tubs, not teaspoons, to catch that gold when it falls. That's the analogy they used, right?
Right. That's the one. Having the capacity to act decisively when those rare opportunities appear.
So thinking about all this deep dive kind of leads to a big question for you, the listener.
Yeah. Based on this discussion, do you feel like you have your own wash tub ready? Are you prepared for potential opportunities?
Or conversely, are you maybe holding on to assets right now that might be, well, significantly overpriced in the current market?
It definitely gives you something to chew on as you look at your own investment strategy.
For sure. Seeing Buffett's actions through this lens really highlights those core value investing principles. Be disciplined, be patient.
And be prepared. Have that capital ready to deploy when things inevitably get rocky and great companies go on sale, even if you have no idea exactly when that will be.
Hopefully this discussion encourages you to maybe explore those principles a bit more in your own investment thinking. It's certainly a long-term game.